the business now manages over 30 billion of assets under management. Metrics Credit Partners primarily focused on large-scale corporate and institutional size borrowers, so lending to large companies associated with listed and private corporates, companies like Woolworths, Origin Energy, Brickworks, Ramsay Health Care, large-scale project and infrastructure debt facilities, so the Sydney Desalination Plant or the WestConnex project, providing financing across real estate transactions primarily focused on high-density residential development and also industrial activity. And then finally, we're involved in acquisition financing. So we run over 30 different vehicles and over 24 billion in primarily corporate and institutional debt. Metrics Real Estate Partners is focused on really providing an equity solution to our clients when we're undertaking a project. And so when we're looking at a particular high-density residential apartment tower or an industrial land subdivision, if the opportunity is there for us to capture part of that asset for the benefit of our investors, where we think we can deliver a higher total return, we might invest through pref equity or equity in the capital structure. And then Navalo Financial Services is the business that we've just brought together. And I think a lot of you might have heard about the growing interest from investors in asset-based lending funds. Well, our view at Metrics is the real benefit for investors in asset-based lending funds come from those that originate the assets. And so in Metrics, through Navalo Financial Services, we're bringing to market a dedicated origination platform focused on consumer and commercial lending. So think of RMBS and ABS issuance. Navalo Financial Services is the entity that originates and manages the risks associated with providing home loans, car loans, personal loans, equipment finance, small ticket commercial property lending. And we currently manage a bit over 7.5 billion in that part of the market. And the intention is that we will start to deliver opportunities for our investors in Metrics funds to gain exposure to asset-based lending strategies. Often people think of the asset class as something that's new. Well, the reality of it is lending is certainly not new. And when you think about the private market, private lending market in Australia, it's very much a bank-dominated market. And so what we've been able to do is really to aggregate capital from investors, use our skill set, our relationships, our networks to originate good quality investment opportunities, and then deliver that return to our investors in a fund format. So I'm a big believer in the benefits of Australian private credit for investor portfolios. One of the few asset classes where I believe a manager can demonstrate to investors that they have taken proactive action to manage risk. So when you think about our role as a lender, we're wanting to find appropriate companies that are driving sufficient cash flow to service and repay their debt. We want to ensure that where we sit in the capital structure, that equity is aligned and equity shareholders where the risk of any potential deterioration in financial performance of a project or a company that we lend to. And then obviously our role is to really mitigate that risk through appropriate terms, conditions, imposing covenants, financial covenants to control the risk that a company might take, and then obviously taking security. All of those actions that we take to mitigate risk is designed to protect and preserve investor capital. And that's one of the reasons why I guess over the last 12 years, we've now been able to demonstrate consistency of performance for investors. But I think also too, the asset class is predominantly a domestic asset class. I hear a lot of people wanting to talk about the benefits of global debt in investor portfolios, in particular in private debt. You're seeing a lot of offshore managers coming to this market looking to raise capital in private wealth markets. My view is that most Australian private wealth clients don't have sufficient diversification across debt investments, and they certainly don't need the complexity of foreign currency exposure impacting their portfolio, nor do they need the leakage associated with withholding tax and the like. And often when you're investing in those markets, you're often skewing your risk profile to what is effectively equity risk. So when we think about the market, obviously everyone will have heard me perhaps speak about this at length, but the key reasons why an investor is looking to invest in private debt as part of a portfolio is really to gain the benefits of stability of capital and the protections of capital, but also to generate higher total returns. And why are the higher total returns really available to an investor in private debt? It's really about the manager's capacity to originate the transaction directly with the borrower, where you're charging fees, negotiating the outcomes, and passing that total return through to an investor. So if you think about the banks, they're reporting their NIMs of sort of between 170 to 200 odd basis points, or Judo at 300 odd basis points. That's just the difference between their cost of funds and their ability to pass that through in terms of what they can charge to their borrowers. So for us, our cost of funds is the equity capital that's been invested and the total return. So if you think about private debt, the thing you're wanting to do is to minimise any potential drawdown or reduction in that return. And so that comes from minimising any potential risk of loss, and also any transaction or costs or management fees. So large, scalable, well-diversified platforms that can pass through the benefits of size and scale, I think can drive better returns through fees and direct origination, but also lower the costs to an investor. When we think about through the cycle, our role as a lender is to make sure that we are forward-looking. We're thinking about what might occur in the future that might impact that company's capacity to generate sufficient cash flow to be able to service and repay its debts. What might occur in the future that might have an impact on the valuation of the company or the project that we're lending to, that might have an adverse impact on the security value of the assets that we hold. And so it's important that we think about this through the cycle. And so setting an appropriate capital structure means that you're also taking action to protect and preserve investor capital. So investing in senior secured first registered mortgage debt in a real estate project is obviously going to be a lower risk position than actual ownership of the asset or the equity of that asset. Importantly, as a lender, if a borrower fails to meet their obligations, then they're contractually obligated to meet those obligations, and if they fail to do that, they run the risk of an event of default and a lender taking control of their position through their securities. But to get to that point, one of the things that's really important in the Australian market, I think, is that a lender has to demonstrate to borrowers that they're a good corporate citizen, that they actually lend on appropriate terms, conditions, that they're not trying to steal the company, they're not trying to enter into a loan-to-own arrangement. And so when we think about this, there are lots of ways in which a lender can protect or take proactive action. Very few firms in the market actually have the depth of skill and talent as we do at Metrics to be able to ensure that you can take proactive action to manage risk. So we put out now a quarterly portfolio report that provides investors with detailed information around the portfolio risk settings of the funds. And you'll see that if you look at that report, that 99% of the portfolio is strongly performing credit. We'll always have a couple of assets that are underperforming their forecasts, or the companies are underperforming, or there's some issue that we need to ensure that we're monitoring the asset closely. But it doesn't mean that we're at risk of losing any money. What it means is that we're concerned about the financial performance of that company, and we want to make sure that that company is taking necessary action to ensure that our investors' capital is protected and preserved. So one of the ways, for instance, you might do that as a lender, you might require a company to go and raise equity capital. Raise equity, pay down the debt. You might require a company to sell assets, pay down the debt. If you can't do that, we might want to encourage you to go and refinance it. So we increase the interest rate and force you to go and find another lender that might be willing to take on the risk. Or if that can't happen, then you're going to leave us with not much alternative, but we'll enforce under our security. We might appoint a receiver. We might actually go through a process to take control of your company through a debt for equity swap. Now, although I talk about that as being something that is an important skill set for a lender to be able to do, the reality is over 12 years with Metrics, I think we've completed well over 1,250 individual transactions, and we've done that on 2 occasions. So it's not a feature that should be prominent in an investor portfolio, but having the skill set to do that, I think, is a clear way in which you can demonstrate that you're taking action to protect and preserve investor capital. Obviously, the key focus of today is about income. So when I think about income, the debt investments that we make really do span a very broad market. One end of the risk spectrum, investors might be looking for a defensive allocation in a client portfolio. You might be looking for an alternative to traditional fixed income. So private debt can play that role. Well diversified, where you've got low exposure to any one individual borrower, with regular income can provide stability of capital and an attractive defensive allocation in a client portfolio. At the other end of the spectrum, you might be interested in higher yielding debt. You might be looking for mezzanine debt, or debt where the manager's negotiated a profit share, or has the rights to equity, or takes an equity-like coupon or return. That might be a suitable equity market replacement in an investor portfolio. So what we've tried to do at Metrics is provide a range of funds to provide investors with choice. And that's really about an investor understanding what is the return objective that I am seeking to achieve for my portfolio? What risk do I need to take to achieve that return? And then what are the ways in which I can ensure that I've got control over my capital through the liquidity of the fund that is offered to me? And so when I look at the different funds that we operate, we can clearly demonstrate in comparison to alternative asset classes and in comparison to alternative fixed income type investment opportunities that the returns and the risk profile is very attractive in private debt. So in terms of manager selection, it is, I think with all of the choice that is available in the market, new LITs being offered on a regular basis and the like, it's really about understanding, well, what is the risk that you're exposed to in those investments? And for my mind, the biggest risk that an investor is exposed to in private debt is the risk of a default and the risk of credit loss in the event of a default. And so being exposed to well-diversified portfolios with managers that are large, scalable, have a demonstrated track record, and are charging appropriate fees, I think is a good indicator of what will be successful. Obviously, governance is an important aspect in terms of all that we do. I want everyone in this room to understand that if you ever look at a Metrics fund, and we've quoted a daily NAV and issued our unit price, you can rest assured that that reflects everything that is known or potentially known in relation to the financial aspects of the fund investments that we hold that would impact that NAV. You should never read a media article and go, oh, I wonder if it's going to impact my performance in Metrics funds. It will already be reflected in the price. And that process comes through having an independent responsible entity, having monthly independent impairment testing and valuations that are undertaken, the process of having an ongoing operational risk review that's undertaken by Mercer Sentinel. We're probably one of the few funds globally in private debt that actually operate S&P rated funds. So all of these things, we just issued our audited accounts, for instance, issued by KPMG for the ASX listed fund. So there is a lot of rigor that goes into that, and it's all designed to give investors confidence that when you're investing in a fund that's managed by Metrics, you can have confidence that that appropriate rigor and governance standard is adhered to, and that you can trust and believe that the quoted daily NAV is correct. And I think for those of you that might recall when the listed fund fell out of bed back in March of 2020 with the pandemic, it traded at $1.25, and we were issuing a $2 NAV consistently through that process. Now, a few years later, I think we've been proven to demonstrate that that was correct, and the performance of the fund reflects that. But for others, in listed funds, it creates an opportunity. And really, there are a couple of key funds that I'd like to quickly talk to, just to wrap this up. There are really a number of fund options for investors to gain access to the asset class through Metrics. Mark mentioned the Metrics Direct Income Fund. So I would say on the defensive allocation side, MDIF, Metrics Direct Income Fund, and MXT were designed to be large, scalable, capital stable, defensive allocations in a client portfolio. Seeks to deliver a minimum return to investors of the RBA cash rate plus 3.25 net. And since inception, now going back over 8 years, we've exceeded that consistently. Then for those of you that are looking for a higher return, potentially with equity upside, MOT might be of interest. And MOT is designed to provide you with exposure to higher yielding debt investments, but also with equity upside. The one fund that I think is misunderstood and not understood in the market is the Metrics Real Estate Multi-Strategy Fund, which is our fund where 50% of the capital is invested in real estate debt, and the other 50% of the capital is invested in real estate equity projects that we hold. Now, if you think about that, the vast bulk of those projects are exposed to high-density residential apartment dwellings and industrial sites. So we just announced, for instance, that we completed the acquisition of a site at One Pacific Motorway up at Coomera to deliver an industrial land subdivision. We've talked about, am I up on time? Just quickly. Oh, okay, thanks. And so that particular fund is designed to deliver not only monthly income from the investments in our real estate debt fund, but also giving exposure to equity projects. So coming back to that, what does that fund deliver? 50% of the capital is invested in the Metrics Real Estate Debt Fund. That fund has now existed for over 8 years. It has delivered a consistent excess return over 90-day bills of over 6.8%. Income distributed monthly, diversified across 145 individual loan assets, and consistently delivered performance for investors through investments in senior secured first registered mortgage debt. So 50% of the return comes through there. So that fund delivered around 11.5% for investors over the last 12 months. Half of that, because half of your capital is invested in that fund, is distributed by way of income distributions each month. The other 50% is invested now across a portfolio of around 15 real estate development projects. Now, each of those is benefiting from a range of outcomes. So for instance, if you look at the market today, interest rates have come off. The feasibility that we've assessed the projects on is now obviously more profitable. If you think about what we actually do, we invest in projects. Those projects, we can determine what is the revenue that is likely to be generated. So if you're going to sell residential apartments, you need to know what is the selling rate per square metre that I'm going to achieve from the mix of 1, 2, 3 bedroom apartments in a particular geographic area. We can identify and be very clear around what the revenue source is going to be. In terms of project costs, what are the project costs that are going to reduce your profit? Well, the land costs, your holding costs, your construction costs, your tax, your marketing, your selling and distribution costs. Well, all of those costs can be largely determined at the time you're entering into the project. So you know, as an investor, what is the profitability of this project likely to deliver? And then what we're seeing is, as we've made these investments, there are a range of things that are coming through. Planning outcomes. Well, the government is helping us. The government wants to see increased supply. So we had 2 high-density residential towers in Chatswood, where we thought we were going to be delivering 34-storey towers, and the government's approved 2 by 46-storey towers. So that's immediately generating higher revenues, higher profitability in that particular project. So there are a range of things that we look at, and then what happens with MRE is that each of those projects, as they're being delivered, you're recognising that profit over the time from commencement of the project to completion. Most projects that we're involved in would be between sort of 2 to 3 years. So over that 2 to 3 year period, you're starting to see that come through. And if you look at the MRE unit price, currently trading at about $2, the NAV of that fund is $2.19. That 19 cents of excess gain today is from the recognition of the profit on those investments that are held in that fund. As we complete those projects, the assets are sold, the tax is paid, and franked dividend distributions will go to investors in MRE. So for those of you that are looking for income, MRE is not only giving a regular monthly income through the debt, but it is providing you with upside in terms of gaining exposure to fully franked distributions at a future point in time as these projects are delivered, and you'll see that reflected in the NAV as it ticks up. Thank you.